Right, we've been talking a lot about the trade story. Let's get specific with companies that are navigating the trade uncertainty right now, especially those with operations in Vietnam, which itself is navigating the Trump administration's moves. This is definitely keeping some of the footwear manufacturers on their feet. Rick Patel is a senior research analyst at Raymond James and joins us with more. Rick, great to have you with us. First of all, for anybody who loves sneakers or any kind of consumer products that are tied to what's on our feet, Vietnam is a very important market to a lot of companies. Can you tell us a little bit more about how the tariff story is impacting business there?
Yeah, appreciate you having me. And look, I would say the tariff situation is developing. It seems like things are changing by the day. But the Vietnam part of the story is something that's particularly noteworthy, I would say, especially for the footwear names that we work on, such as Nike, Deckers, On Running, and Under Armour. These are companies that I would say over the past several years have made a concerted shift to move production out of China since Trump's first presidency. They thought they were mitigating the risk by moving out of China, moving some of their sourcing operations to Vietnam. And then here we are today, with Vietnam being targeted with higher tariffs. So it is something that we need to watch. I would say if you're a footwear lover out there, do not wait to buy shoes. I think the prices are likely to go up in the coming months as these companies try to navigate these higher costs.
Interesting. Well, maybe we can go through our audience. I'm sure they love footwear. They also love stocks. So let's go through these individual companies to best understand how each is navigating and your view as an analyst. So you mentioned Nike. Let's start with Nike. What's your view on Nike right now?
Yeah, so Nike, we have a market perform rating on. We are on the sidelines. Besides the tariff headwinds, it's really a host of issues that are weighing on the company. As you might be aware, the company is in the process of moving away its emphasis on the classic part of the assortment that they have, the Air Jordans, the Dunks, the Air Force Ones that did so well during COVID. But the consumers have really moved on from that fashion trend. And the company is in the process of moving a lot more towards towards performance products that are, more geared towards athletes. And it's a work in progress right now. The company's revenue is in decline as they navigate this shift. I would also add that China is a big component of Nike's business, about 15% of its revenue, and China is also declining double digits right now. So it's a work in progress story from a fundamental point of view on the demand side of things. And then add to that this tariff headwind, which the company sized at about $1 billion. That's about 220 basis points of pressure on gross margins. They think they can mitigate a decent portion of that, and they think the net impact is going to be 75 basis points on the margins, but it's still material, so headwinds on the top line and bottom line for Nike.
All right, and unfortunately, we're almost out of time, but you mentioned your market perform rating on Nike. You have a similar, I believe, call on Under Armour. But On Holding, and obviously their shoes have been very popular, and Deckers, which has had equally a lot of success in growing their own sneaker franchise. Those are stocks that generally you've been more constructive on. What would be your thoughts on, very quickly, how they're navigating this?
Yeah, so in terms of navigating the tariffs, every company is, reacting the same way in terms of working with manufacturers, working with their wholesale partners and trying to absorb some of the costs while passing along higher price increases. So I think the methodology is consistent across most companies, but we do like On and Deckers. Deckers has the Hoka brand. We think both of these brands are very early lifestyle brands with a multi-billion-dollar runway for growth. And both of these companies generate about $2.5 billion of revenue. So they're much smaller brands that we think can grow into much larger brands over time, and that's what we like.